On March 5, 2026, the Dow Jones Industrial Average dropped 784 points in a single session. Screens went red. Retail investors panic sold. Financial media melted into a wall of flashing warnings and breathless commentary. And while all of that was happening, one man quietly wired $15 million of his own personal money to buy stock in a single company. That man is Greg Abel, the chief executive officer of Berkshire Hathaway, the company currently sitting on approximately $325 billion in cash. The largest corporate cash reserve in the history of American business. Here's what makes this extraordinary. Under SEC regulations, executives are legally required to file a Form 4 disclosure for any open market purchase within 2 business days. Abel knew the entire world would see this transaction. He didn't do this quietly, he couldn't. And on the same day, Berkshire Hathaway announced the resumption of share buybacks for the first time since 2024. The question isn't why he bought. The question is what Greg Abel knows about Berkshire's intrinsic value that the rest of the market hasn't priced in yet. My name is Alex, and I've spent the last decade tracking capital allocation signals and insider purchase filings, so you don't have to. If you want to understand what the most informed people in American business are actually doing with their money, not what they're saying on television, make sure to hit that subscribe button and give this video a thumbs up if it helps you see something the market is missing. Before we dive in, I want to know, are you buying this dip, holding your positions, or moving to cash? Drop your answer in the comments because I genuinely want to see where this audience stands right now. Here's what I'm going to show you today. Greg Abel's $15 million purchase is not just an investment, it's a succession signal. It's the first major capital allocation declaration of the post-Buffett era, and it directly contradicts what the gold and silver rally has been screaming for the last 12 months. But there's a layer underneath all of this that most analysts haven't touched. A layer that connects to a much bigger question about where real value lives for the next decade of American markets. Abel just answered that question with his own money, and by the end of this video, you'll understand exactly what his answer means for yours. Now let's set the stage, because if you just saw the headline, you might think this is a routine insider buy. A CEO buys stock in his own company. Happens every day, right? That's exactly backwards. To understand why this is fundamentally different, you need to understand who Greg Abel is, how he thinks, and why Warren Buffett handpicked him out of every possible candidate on the planet. Abel ran Berkshire Hathaway Energy for years. Not a flashy tech division, not a media empire, an energy utility operation. The most capital-intensive, longest duration, most boring on-purpose business in the entire Berkshire portfolio. We're talking about power plants, transmission lines, infrastructure that takes decades to build and decades to pay off. Buffett chose him precisely because Abel thinks in decades, not quarters. He's known internally as one of the most disciplined capital allocators Berkshire has ever produced. The kind of executive who reviews every dollar of spending personally, who flies commercial, who shows up at operational sites unannounced at 6 in the morning. So, when a man like that takes $15 million of his personal wealth, money he earned over a career, money that represents years of his life and his family's security, and puts it into Berkshire stock on a day when the market is in absolute freefall, that's not a casual decision. That's not portfolio rebalancing. That's a public declaration of conviction so loud it might as well have come with a press conference. Except Abel doesn't do press conferences. He files Form 4s. And in many ways, that's even more powerful. Because a press conference is words. A Form 4 is money, his money. But here's what shifts this from interesting to critical. This isn't just about one man's confidence. It's about what his confidence means in the context of a pattern that has made people fortunes before. The 2008 parallel looks obvious on the surface. But there's a critical difference between what Buffett did then and what Abel just did. And that difference is what makes this signal either more powerful or far more dangerous. In October of 2008, at the absolute depths of the financial crisis, Warren Buffett published his now famous op-ed in the New York Times titled, "Buy American, I Am." The stock market was in freefall. Lehman Brothers had collapsed weeks earlier. AIG was being bailed out. The entire global financial system genuinely appeared to be disintegrating. Credit markets were frozen. Banks wouldn't lend to each other. People were pulling cash out of money market funds, something that was supposed to be impossible. Fear wasn't elevated, fear was total, and Buffett stepped directly into that void. He didn't just write about conviction. Berkshire made massive crisis investments. $5 billion into Goldman Sachs on preferential terms that gave Berkshire a 10% annual dividend plus warrants. $3 billion into General Electric on similar terms. A sweetheart deal with Bank of America that would eventually become one of the most profitable single investments in corporate history, worth over $30 billion at its peak. The message was consistent and devastatingly clear. When fear peaks, patient capital acts. When everyone is sprinting for the exits, the person with cash and conviction walks through the front door and negotiates from a position of absolute strength. Abel's purchase on March 5th follows the exact same structural pattern. A market in turmoil, driven this time by Iran war escalation and geopolitical chaos instead of a banking crisis. A man with access to more information than almost anyone alive choosing to buy when the crowd is selling. A company with an unprecedented cash reserve sitting on the sidelines, finally making a move. But here's the critical difference, and this is the part that elevates the signal. In 2008, Buffett deployed Berkshire's capital into other companies, Goldman, GE, Bank of America. He was buying external assets at distressed prices from desperate sellers. Abel's first move is different. He's buying Berkshire itself. And Berkshire simultaneously resumed its own share buyback program for the first time since 2024. That distinction matters enormously, and I need to explain why it changes everything. Berkshire's buyback policy is one of the most explicit in corporate America. The company only repurchases its own shares when management conservatively estimates the stock price has fallen below intrinsic value. Read the shareholder letters. It's stated plainly, year after year, in black and white. This isn't a vanity buyback designed to artificially boost earnings per share the way most corporations use buybacks. This isn't financial engineering. This is a mathematical statement from inside the machine. Abel and his team ran the numbers on what Berkshire Hathaway is actually worth. Every subsidiary, every investment position, every dollar of that $325 billion cash pile, every future cash flow from the insurance operations, the railroad, the energy utilities, the consumer brands. They modeled it all, applied conservative assumptions, and concluded that the market was handing them a discount on their own company, and then they acted on it. Now stay with me here, because this is where the $325 billion question gets answered, and it's the part that took me the longest to fully process. For 2 full years, throughout 2024 and 2025, Warren Buffett himself refused to deploy that cash. Quarter after quarter, the cash pile grew. It went from $200 billion to $250 billion to $300 billion and beyond. At the 2025 annual meeting, covered extensively by CNBC, Buffett told shareholders directly that attractive prices were hard to find. Let the weight of that statement hit you. The greatest capital allocator in the history of modern finance, sitting on the largest corporate cash reserve ever assembled, looked at every available opportunity on earth, every stock, every company, every deal, and said nothing is cheap enough. The cash pile kept growing. Analysts started questioning whether Buffett had lost his edge. Financial commentators speculated he was hoarding cash out of fear. Some said he was preparing for a crisis. Others said he simply couldn't find elephants to hunt anymore. And then his hand-picked successor walks in. The market drops 784 points in a single session. And Abel signals, with his own personal money and with Berkshire's corporate treasury, that something is finally cheap enough. And that something is Berkshire itself. That's not a small tactical adjustment. That's a philosophical declaration about where value has finally appeared after 2 years of extraordinary patience. Buffett couldn't find value anywhere in the world. Abel found it in his own backyard. Here's where this gets uncomfortable, and I need you to stay with me because this is the part that forces you to question every assumption you've been operating under. Gold is up over 100% in the past 12 months. Silver surged from roughly $24 to a peak near $120. According to JP Morgan's precious metals research, gold has experienced its fastest sustained rally since the 1970s. The metals market has been on an absolute tear, and the narrative driving it is straightforward and compelling. War-driven inflation, dollar debasement concerns, central banks around the world accumulating gold at record pace, geopolitical instability that makes 2008 look like a minor disagreement. The precious metals market is screaming, loudly and consistently, that hard assets, tangible stores of value, are the only safe harbor in this storm, and honestly, a lot of the data supports that thesis. Real yields, the return you get on Treasury bonds after subtracting inflation, have turned negative according to Federal Reserve tip spread data. That means the so-called risk-free rate is actually guaranteeing you a loss in purchasing power. When the safest asset in the world is a guaranteed loser, something fundamental has broken. But here's where Buffett's own philosophy creates a paradox that absolutely nobody is talking about. Think about this carefully. $325 billion sitting in cash and short-term treasuries. Buffett, the man who famously rejected gold his entire life because, and I'm paraphrasing him, it just sits there. It doesn't produce anything, it doesn't generate earnings, you can stare at it and it won't do a single thing for you. That man has been holding the one asset class that's actually losing purchasing power faster than gold would have. His treasuries have been bleeding real value every single month. The man who called gold unproductive was holding something demonstrably less productive in a war inflation environment. The philosopher who built his empire on the superiority of productive assets spent 2 years sitting in the one asset that produces nothing but a negative real return. Let that contradiction settle in your mind for a moment, because Abel's buyback is the first attempt to resolve it. By deploying capital into Berkshire stock, Abel is effectively saying, I'd rather own productive American businesses at these prices than watch our cash pile shrink in real terms for another quarter. He's choosing productive assets, insurance companies that collect premiums and invest the float, a railroad that moves a third of American freight, energy utilities that generate power for millions, consumer brands that can raise prices with inflation over both gold and cash. That's a three-way bet. Not just equities over metals. Equities over the inertia of sitting in treasuries that even Buffett himself couldn't bring himself to abandon. Abel is doing what Buffett's own logic demanded, but Buffett wouldn't do. Now I know what some of you are thinking. But Alex, gold just doubled. Silver went 5x. Why would I listen to a guy buying stocks when metals are printing generational returns? And that's a completely fair question. I'm not going to dismiss it. Here's the thing though. Abel isn't saying gold investors are irrational. He's not making a call on gold at all. What he's saying, with $15 million of his own money, is that known intrinsic value is more reliable than momentum in either direction. Gold could go higher. Silver could absolutely go higher. But can you calculate what an ounce of gold is truly worth the way Abel can calculate what a railroad earning $6 billion a year is worth? Can you model gold's future cash flows? It doesn't have any. You can model the demand, you can track central bank buying, you can analyze the macro thesis, but at the end of the day, gold's value is whatever the next buyer will pay. That's not a criticism of gold, it's a description of a fundamentally different framework. Abel's entire career has been built on the discipline of intrinsic value calculation. He knows exactly what Berkshire's businesses earn. He knows what they'll earn next year within a reasonable range. He can put a number on it with precision that gold investors simply cannot replicate for their asset. And when the price drops below that number, he buys. That's not bravery. That's math. So here's where the portfolio question gets real for you personally. Because the honest answer isn't either or, and anyone telling you it is doesn't understand the current environment. The war-driven inflation regime creates a genuine, defensible case for stores of value. Gold and silver serve a real purpose in a world where governments are spending without constraint and real yields are negative. Hard assets protect purchasing power. That's their job. They do it well. But productive businesses that generate cash flow, raise prices alongside inflation, reinvest earnings, and compound value over decades serve a completely different purpose. They don't just preserve wealth, they create it. The question isn't gold or Berkshire. The question is, what percentage of your wealth do you want in assets that produce nothing but protect purchasing power versus assets that produce cash flow but carry market volatility? Abel just answered that question for himself. $15 million says productive assets at discounted prices beat everything else on a 10-year horizon. But here's a hard truth that might sting. Most people watching this will do neither. They won't buy gold at these prices because it already ran and they feel like they missed it. They won't buy equities because the market is falling and the headlines are terrifying. They'll sit in cash, earning a savings account rate that is the one asset mathematically guaranteed to lose value in a negative real yield environment. That's not caution. That's the most expensive decision you can make. Abel made his move. Berkshire deployed its capital. The signal is on the public record for anyone willing to read it. Now it's your turn. Gold, silver, Berkshire, the war economy, real yields, negative returns. I cover all of it on this channel. What's the signal you're seeing right now that nobody is explaining properly? What financial question is keeping you up at night? Drop it in the comments. That's exactly what this channel is built for. I read every single one. I'll see you in the next one. Every piece of this puzzle, the crash day purchase, the buyback resumption, the $325 billion war chest finally being deployed, the gold contradiction buried inside Buffett's own philosophy, it all connects to one question about the next decade of American markets. And Abel just answered it with his own money. Now let me tie all of this together, because the succession element is what elevates this from a market signal into something that will be studied in business schools for decades. Greg Abel is not Warren Buffett. He doesn't have 60 years of compounded credibility. He doesn't have the folksy one-liners, or the cherry coke, or the annual meeting that draws 40,000 people to Omaha like a financial pilgrimage. What he has is the weight of being chosen. Buffett, who spent his entire career arguing that evaluating human judgment is the single most importance removed in capital allocation, looked at every executive in his empire and said, "This is the one I trust with $750 billion in assets and the legacy I spent my entire life building." Abel's first major capital allocation signal sets the tone for the entire post-Buffett era. Every future Berkshire decision, every acquisition, every investment, every quarter of reported earnings will be measured against this moment. If he's right, if March 5th, 2026 turns out to be a point of maximum fear and minimum valuation, Abel inherits not just the title but the credibility that comes with being tested under fire and proven correct. He becomes the legitimate successor in the eyes of the market, not just the chosen one, the proven one. But if he's wrong, if the Iran conflict deepens, if inflation accelerates beyond anyone's models, if equity valuations crater for years, then $325 billion, the most powerful pool of capital in private hands, is being steered by someone who misread his first crisis. The stakes aren't $15 million, they're generational. They're the entire question of whether the Buffett philosophy survives the man who created it. And that brings us back to where we started. On March 5th, 2026, the Dow dropped 784 points. Millions of people sold. One man bought. He filed the paperwork knowing every analyst, every fund manager, every financial journalist, and every algorithmic trading system would see it within 48 hours. He's the CEO of the company sitting on the largest cash reserve in corporate history. He was handpicked by the greatest investor who ever lived. And his first act as capital allocator-in-chief was to put his own money where his conviction is. Warren Buffett wrote op-eds. Greg Abel filed a Form 4. Same conviction, different language, different era. But the signal is identical. When fear peaks, patient capital acts. It happened in 2008. It just happened again. The pattern has repeated. The playbook is public. The Form 4 is filed. The only variable left is you. Your future self, the one looking back at 2026 from a decade down the road, isn't going to remember what the headline said. They're going to remember what you did. Whether that's productive assets, precious metals, or a deliberate combination of both, the one unforgivable move is sitting frozen while your purchasing power evaporates in an account earning negative real returns. That's not caution. That's the most expensive decision you can make. Abel made his move. Berkshire deployed its capital. The signal is on the public record for anyone willing to read it. Now it's your turn. Gold, silver, Berkshire, the war economy, real yields, negative returns, I cover all of it on this channel. What's the signal you're seeing right now that nobody is explaining properly? What financial question is keeping you up at night? Drop it in the comments. That's exactly what this channel is built for. I read every single one. I'll see you in the next one.